If you're bullish and don't want to burn cash, and if you're bearish and don't want to bet your entire house, then option spreads is the way to go. Hi, I am Pranav VK, an NISM certified trader and trainer, and your options trading guide here at Stockshaala by Kotak Securities. Unlike naked calls or put buying, debit spreads allow you to enter into the same direction without much cost and well-defined risk. We can use net debit spreads when market moves moderately in our direction, and it works really well near trend confirmations as well as breakouts. Let's start with the first net debit spread, that is the bull call spread. A bull call spread is created by buying an at-the-money call option and selling an out-of-the-money call option. Now, if you don't understand what is at the money, out of the money, or in the money, I would highly recommend you to go ahead and watch the Moneyness in Option Contracts video on our YouTube channel. Now, let's head to the whiteboard to understand a real-life example. Here, I have taken at the money call option, that is 19,400, which is trading at rupees 100. So since we are buying, we are paying a premium of rupees 100 in this case. And the second one is selling an out of the money call option, that is 19,600 CE, which is trading at rupees 40. Since we are selling this contract, we are receiving a premium of rupees 40. And the net cost for entering into this spread is nothing but the premium that we paid minus the premium that we received. That is 100 minus 40, that is rupees 60. And to calculate the maximum profit of this spread, it is a simple formula. We need to subtract the strike prices, which is 19,600 minus 19,400, that is rupees 200, minus the total cost, that is rupees 60. So 200 minus 60, the total maximum profit that is possible in this spread is rupees 140. So here in this case, the maximum loss is nothing but the net cost that we have paid to enter into this specific spread, and that is rupees 60. Let me give you an analogy to help you understand this better. Imagine you're booking a flight with a fixed destination. It has no surprises but only safety. And that's exactly how a bull call spread looks like. Whereas naked call buying is like booking a flight without knowing where the destination is, full of surprises. Now that we know the maximum profit and maximum loss, now let's also calculate the break-even point. The break-even point is given by the formula, the lower strike plus the net premium. In this case, the lower strike is 19,400 call option, plus the net premium is rupees 60, which is 100 minus 40. So our break-even point is 19,460. And we get into this kind of a net debit spread when we are expecting the market to go upwards. The biggest advantage of a bull call spread is that you are able to enter into the entire position with a limited capital exposure. Now that we know the risk reward as well as the break-even point of the spread, now let's draw the option payoff diagram so you understand it very clearly. Heading to the whiteboard, here I have drawn the option payoff diagram of this exact bull call spread. We have profits on the top side and losses on the bottom side. And we have the x-axis where we have the various possible strikes. We have calculated that the break-even point is nothing but the lower strike, that is 19,400, plus net premium, that is 100 minus 40, that is 60. So it is 19,460. And we also calculated the maximum loss, which is the 100 rupees premium that we paid minus the 40 rupees premium that we received. So that is going to be rupees 60. And finally, the maximum profit is nothing but the difference in the strike prices, that is 19,600 minus 19,400, that is rupees 200, minus the cost of entering into this spread, that is rupees 60. And that is finally 200 minus 60, that is rupees 140, which is the maximum profit. Now similarly, let's talk about a bearish spread, which is called as the bear put spread, which is also another net debit spread. A bear put spread is very similar to a bull call spread. The only difference is that instead of a call option, here we are going to be using put options. So which means the first thing is you're going to buy at the money put option and you're going to be selling out of the money put option. Let's look at a real example to understand this better. Heading to the whiteboard, the first one we have is buying at the money put option, which is 19,600 put option at rupees 120 premium, which means we are paying rupees 120. And the second one is selling out of the money put option, that is 19,400 put option at rupees 50, which means we are receiving this rupees 50 as premium. That brings us to the next one, net cost, which is 120 rupees minus 50, which is 70 rupees to enter into this spread. And finally, the max profit is nothing but the difference in strikes, that is 19,600 minus 19,400, which is rupees 200, minus the cost of entering into the spread, that is rupees 70. So the total profit is going to be rupees 130. Now let's also calculate the break-even point for this spread. The break-even point for this spread is given by the higher strike, that is 19,600, minus the net premium, that is 70. So that is nothing but 19,530. A bear put spread is like insuring your stock portfolio, but only for a limited fall. You can enter into a bear put strategy when you're expecting moderate downfall. And the best part is that you can enter into the strategy with limited capital exposure instead of naked put buying. Now let's head to the whiteboard to look at the payoff diagram of a bear put spread. Here, as usual, we have the profit on the y-axis as well as the loss, and on the x-axis we have the various strikes. Starting with the break-even point, we know that it is nothing but the higher strike, which is 19,600 minus the net premium, which was 70, so it is 19,530. The maximum loss is nothing but the total premium that we have paid minus the premium that we have received, that is 120 minus 50, that is rupees 70. And finally, the maximum profit is nothing but the difference between the two strikes, that is 19,600 minus 19,400, that is 200, minus the net premium that we have paid to get into this contract, that is 70. So 200 minus 70 is 130 rupees, which is the maximum profit. Now let's compare both these debit spreads using payoff diagrams to understand clearly when to use each of them. Here you can see the payoff diagram where I have combined the bull call spread payoff diagram as well as the bear put spread. So clearly we can see that we are going to use a bull call spread when we are moderately bullish on the market, whereas we are going to use a bear put spread when we are moderately bearish on the market. So we know that in both these cases, we are buying at the money option, whereas we are selling out of the money option, which means we are paying a higher premium than how much we receive, which means both of them are net debit spreads. The maximum profit for both of these strategies are calculated by the strike difference between the ATM and OTM minus the net premium. The maximum loss of both these strategies is nothing but the net cost, which is the amount of premium that you have paid minus the amount of premium that we have received. So in this case, it was rupees 60 in the bull call spread, and whereas in this case, it was rupees 70 in the bear put spread. So to calculate the break-even points for both the strategies, there's a simple formula. For the bull call spread, it is nothing but the lower strike plus the net premium, whereas for the bear put spread, it is the higher strike minus the net premium. Here are a few key mistakes to avoid. Number 1, please make sure that you're checking the IV before entering into the strategy. If the IV is already high, which is implied volatility, then it is better to go for net credit spreads instead of a net debit spread. Also, avoid strikes with low liquidity or high bid-ask spreads. And finally and most importantly, calculate your break-evens properly and don't just enter into the strategy just because it's cheaper. So let's summarize what we have learned so far. We have understood that bear put spreads or bull call spreads are your go-to tools when you want to ride the waves without the roller coaster of emotions. Even though these tools are great, please remember that net debit spreads are equivalent to option buying and the probability of profit are still significantly lower and less than 33%. These net debit spreads are lower cost compared to naked options. They have defined risk to reward, and as well as it is good for smart directional views, which is moderately bullish or moderately bearish. Next up, we'll flip the table and talk about net credit spreads. So make sure you're staying tuned because you're watching Stockshaala by Kotak Securities, where we learn, trade, and grow together. Share this with your friends and also comment about how you think about net debit spreads. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.